All right, welcome, gang, to another installment in the lecture series for financial accounting. We're moving on to Chapter 9 now, and this will be accounting for accounts receivable. And we've already had introduction to these in our previous chapters, but let's review just briefly here. Accounts receivable are, of course, the accounts that we have are receivables designated amount that is owed to our company by another party. And usually when it's in the accounts receivable department, that means it's from a customer. Notes receivable would be things where we actually formally lend money to someone. And there's other forms of receivables that we'd have, but accounts receivable is generally the businesses that we normally do business with, our customers, in other words. And in the past, we've kind of dealt with accounts receivable as one generic account. But the way a company really does it is we need to maintain separate account receivable for each and every customer that we advance or that we sell to on credit, so that we know how much each individual customer owes us going forward, how much they've already paid us, and so forth. So let's run through a couple quick examples just to demonstrate what I mean. To do that, let's use an example of a sale that our company is going to make. And our company in these examples will be TechCom, okay? We actually sell high-end electronics to other companies. And so on July 1st, in our first example here, TechCom's making a credit sale, $950 to CompStore. And for now, let's ignore the inventory and what the cost of goods sold are and just deal with the sales side of it. But of course, you guys know how to do this, right? We're going to recognize some revenue, which is of course called sales. And since this company CompStore is going to owe us $950, we would need to debit the accounts receivable, but the specific accounts receivable from CompStore. So we would create, if we don't already have an account, we would create a new accounts receivable CompStore account. Notice that, and it's very simply written. We'll just put a dash and whoever the customer is right after accounts receivable. Now, on our financial statements, which we publish to the public so that everyone can see our financials, or at least some investors or owners can see our financials, we wouldn't list all of the individual accounts receivable for every customer because, frankly, there could be thousands or tens of thousands or more accounts receivable accounts, and the financial statement would look pretty darn messy. Our general ledger will have hundreds or thousands of accounts receivable, but we will just publish a summary, and we will call it accounts receivable, and that totals up all of the amounts that are owed to us by the various accounts receivable. But something that we do need to pay attention to is we will actually keep track and have general ledger accounts for each individual customer of ours. Now let's take a look at an example of a decrease in accounts receivable. What we just saw before, when we make sales, that would be an increase. This would, of course, be a decrease to an accounts receivable. And by the way, you'll see me abbreviate accounts receivable with an A/R. Feel free to do the same. On July 1st, same day, our company received $720 from RDA Electronics, another customer of ours, from a prior credit sale. So, of course, we're going to want to reduce their accounts receivable. Remember, accounts receivable is, of course, an asset account, right? It's something that we own that will give us future benefit in the future. So it has a normal debit balance. And that's why we debited it to show an increase in the previous example. Now we're getting a receivable paid off by one of the customers. We need to show a decrease, so we will, of course, credit it. And the other side of this is, of course, we're receiving the cash from our customer. So we debit cash, credit accounts receivable specific to the customer that paid us, right? We want to credit the accounts receivable for RDA Electronics to show that that customer has paid the $720 that they owed us. And if you can think about the general ledger account, what it would have looked like, assuming all that RDA owed us was the $720 from before, well, previously when we made a sale, we would have debited the accounts receivable RDA Electronics. It would have had a $720 debit balance in it. And then on July 1st, when they finally pay it off in this journal entry, once we post this journal entry to the ledger, we would be crediting that same account and giving them a zero balance, showing that RDA Electronics no longer owes us any money. Now, of course, when you allow your customers to owe you and keep things on their account, sometimes customers are not going to pay their debts, and that's an unfortunate part of extending credit. But it is a part of doing business. And most companies, when you have a lot of businesses that you are selling to, if your customers are businesses, they're going to need credit extended, so it's generally a part of doing business. But it creates a new type of expense that we haven't learned before, and it's referred to as bad debt expense. So I want to introduce that to you. Now, in this chapter, you'll see that the text reviews two methods of accounting for bad debts. The first one is called the direct write-off method, and that is not generally accepted accounting method. We are going to review it, and I want to demonstrate it just to show you how we would do this, but keep in mind it is purely demonstrative to show what we will not be doing. What we will be doing, what we will be following, and what I'll be testing you and quizzing you on, and you'll be practicing in the homework, is the second one, the allowance method. But I think it helps demonstrate the concepts by going through the direct write-off method, even though it's not what we'll be doing. The reason that we won't use the direct write-off method is because it usually doesn't match expenses with revenues, which is specifically required, right, by the matching principle, or the expense recognition principle, which we learned way back in chapter 1 and we've gone over and over. That concept, once again, is we want to match the expenses with the revenues that those expenses helped create. Meaning you want to report both the expenses and the revenues in the same period. And the problem is, of course, if you use this method, as you will see in a moment, it doesn't necessarily match the bad debt expense with the revenue that those extending credit actually help generate. Let's go through an example. So again, our company is TechCom, and it's December 1st. We're getting close to the end of the year. Let's call that year 1 for now. And we make a sale to one specific customer called J. Kent for $520. And the goods that we sold them cost us had a cost basis of $200. That's what our inventory cost us. Remember, of course, when we make a sale, there would be two journal entries, right? The revenue side and, of course, the inventory and cost of goods side. So the revenue side, of course, well, we're generating $520 of revenue, right? And Mr. Kent is buying this, but he's, remember, purchasing this on credit, so he's going to owe us $520. So for the first part, we've been debiting accounts receivable for $520 and crediting sales, right, to show the revenue of $520. And now the inventory side, we need to show that we no longer have $200 of inventory that we just sold. We'd be crediting the merchandise inventory account and, of course, debiting the cost of goods sold account. This should look familiar, right? Now, let's fast forward a little bit into the next year and actually stop and think if we were to publish our financial statements, what we would be showing is that we had revenue of $520 and the expense that's related to that is just the cost of goods sold, but nothing related to bad debt expense. Let's fast forward into the next year. It's January 23rd, and now we determine that our customer, J. Kent, the one who just purchased those things from us a couple months ago, but in a different accounting period, right, in a different year, is not going to pay us the $520. And there's different ways that a company would determine this. We could find out, we could send bill after bill with no response, call our customer, put them into collections and determine we're not getting anything. Sometimes a customer will call and just say, hey, sorry, I can't pay you guys. I'm going out of business. Been nice knowing you. Or they leave the country or someone drives by their offices and it's boarded up, out of business, and we just know we're not going to get paid. Well, in the direct write-off method, the way we would take this off our books, so to speak, is number one, we're still reporting accounts receivable, right? That's an asset that we're showing we own that we expect to get $520 from Mr. Kent in the future. Well, the moment we know we're not going to get it, we have to take that off our books because, frankly, it's inaccurate to say we're going to get that in the future. We know we're not going to get the $520. So how do we write this off of our books, this $520 debit balance in the accounts receivable? Of course, we credit his account receivable for $520. And this is where the new expense comes in, right? It's a bad debt expense. So we will properly show that his accounts receivable is now at a zero balance by putting a credit amount equal to the debit amount that's in there. And of course, now we're recognizing the bad debt expense. The problem, of course, is that we showed revenue in year 1, and now all of a sudden we've got an expense in year 2. And these two should have been matched, right? The expense should have been in the same period as the revenue. Of course, you're sitting there thinking, well, we didn't know he was going to not pay us the $520, so how could we have possibly done that? And that's what the allowance method will teach us in just a bit. We just estimate what our bad debts are going to be. But we'll talk about that in just a bit. Let's stay with the direct write-off method for now as we go. And keep this in mind as we go forward, this journal entry specifically. When we believe that we were not going to collect this amount, we wrote off his account receivable with a credit, and we recognize the bad debt expense with a debit. Now, let's talk about recovering a bad debt. What that means is every once in a while when we write off a bad debt, our customer will actually come through and pay even though we believe they were not going to. So we need to reverse what we just did, right? Previously, we credited Mr. Kent's accounts receivable by $520 because we believed he wasn't going to pay us, and we recognize a bad debt expense with a debit of $520 as well. Now let's assume that Mr. Kent actually sends us a check for $520 that we thought we weren't going to collect. Well, the first thing we need to do is reverse what we just did, right? We need to now debit his account receivable for $520 and, of course, credit the bad debt expense because we're reversing what we just did before. This is identical to the last journal entry we saw on the last page, right? Debiting accounts receivable to show that actually Mr. Kent does still owe us the $520 and we are going to collect that, and therefore we don't need a bad debt expense of $520. That was a mistake that we did. And, of course, we have now received the cash from Mr. Kent, so we need to recognize that and simultaneously write off his account receivable because he no longer owes us $520. He's just paid us. So we're really just reversing what we did before to get us back to the original state of his account, showing a $520 debit balance in his receivable, and then we're just showing the collection of that receivable. Now, that's the direct write-off method. Like I said before, that's not generally accepted accounting principle. That's not what we use for general accounting, but I did want to demonstrate it, and those concepts will help us with understanding the allowance method, which we'll take up on part 2 of this video. See you guys then.